Over the past 2 years, the world has gone absolutely mad for AI. We've seen an explosion in investment, with companies pouring an astonishing $10 trillion into the race for artificial intelligence supremacy. We've watched Nvidia's stock price rocket from around $150 to over $900. We've seen Microsoft throw $60 billion at the wall, with everyone from Google to Meta betting their entire futures on AI. It feels like a revolution, a guaranteed path to untold riches. But I'm here to tell you something that might be hard to hear. The math doesn't add up, not even close. What we're witnessing is a bubble, a massive $10 trillion bubble that is getting ready to pop. And when it does, it's going to make the dot-com crash of 2000 look like a minor market correction. Let's start by looking at the staggering amount of money being spent. Just on infrastructure, the chips, the servers, the data centers, we're talking about $1 trillion over 3 years. The big 5 tech giants, Microsoft, Google, Meta, Amazon, and Apple, have collectively spent over $300 billion in just the last 2 years. Microsoft leads the pack with over $60 billion, including its $13 billion bet on OpenAI. Google isn't far behind at $50 billion. Meta has burned through $40 billion, and Amazon is in for $30. All this spending has created a gold rush for one company in particular, Nvidia. Their revenue exploded from $15 billion in 2022 to an expected $100 billion this year. Why? Because a single one of their advanced AI chips can cost up to $40,000, and building a single AI training cluster can set a company back $1 billion. The spending is astronomical, unprecedented, and happening at a breakneck pace. So with all this money being poured in, the revenues must be pouring in too, right? Wrong. This is the heart of the problem. This is where the whole story falls apart. Let's take a look at the poster child of the AI revolution, OpenAI. They are on track to bring in about $3.5 billion in revenue. Sounds good, until you realize their costs are over $5 billion. They are losing $2 billion a year while being valued at an insane $150 billion. That's a valuation of 43 times their revenue for a company that is actively losing money. It's madness. What about Microsoft? They've spent $60 billion, but their AI products are generating maybe $10 to $15 billion in new revenue. At that rate, it will take them 4 to 6 years just to break even on their initial investment, assuming costs don't continue to skyrocket. Google has spent $50 billion and is projected to bring in around $15 to $20 billion in AI revenue. But in a panic to compete, they're giving away their flagship AI model Gemini for free. They're literally giving away a product that cost them billions to develop. Meta has spent $40 billion with almost no new revenue to show for it. Amazon's Alexa has been losing billions of dollars a year for a decade. Do you see the pattern here? The industry has spent over $300 billion to generate, at best, around $15 billion in new attributable revenue. That's a 20-to-1 spending-to-revenue ratio. You would need 20 years just to get your money back. This is not a sustainable business model. Well, maybe the user growth will save them. Let's check. ChatGPT, the most popular AI service, has about 10 million paying subscribers. At $20 a month, that's $2.4 billion a year. But as we saw, they still lose billions on the sheer cost of running the service. Microsoft's Copilot has fewer than 5 million users, bringing in less than $2 billion a year. It's just not enough to justify the colossal spending. Even worse, the explosive growth we saw initially has plateaued. The number of new sign-ups is now roughly equal to the number of people cancelling their subscriptions. The market is turning out to be much smaller than everyone hoped. What about the enterprise market? A study from MIT found that AI improves worker productivity by about 26%. That's good, it's solid, but it's not the transformational, game-changing revolution that was promised. It certainly doesn't justify a $10 trillion valuation spike. The next crisis brewing is the cost of the technology itself. The dirty secret of AI is that the models are getting bigger and more expensive to train and run, not cheaper. Training GPT-4 cost over $100 million in computing power alone. GPT-5 will cost significantly more. But the real money pit is inference. The cost of running the model every time you ask it a question. Each query costs between 1 and 4 cents. If you have 10 billion queries a month, that's up to $5 billion a year just to keep the lights on. This model doesn't scale profitably. The more popular your service becomes, the more money you lose. It's a recipe for disaster. And if the financial cost wasn't enough, there's the environmental cost. The energy consumption is staggering. Training GPT-4 used enough electricity to power 5,000 homes for an entire year. A single data center with 10,000 AI chips consumes as much power as a small city. By 2027, the AI industry could consume more electricity than the entire country of Argentina. This is not just a line item on a balance sheet. It's an unsustainable drain on our global power grid that will have very real consequences. All of this brings us to the bubble. When you see a company like Nvidia, whose stock has multiplied by 6 in 2 years, trading at a price-to-earnings ratio of 65, when anything over 50 is traditionally considered a bubble, you have to be concerned. The market is pricing these companies for absolute perfection. Any hint of a slowdown, any sign that the revenue isn't materializing, and the house of cards will come tumbling down. This is the dot-com bubble 2.0. Back in 1999, everyone was convinced the internet would change the world, and they were right. But they bid the stocks of any company with "com" in its name to insane, unsustainable valuations. Then reality hit. The Nasdaq crashed by 78%. $3 trillion of wealth vanished. The companies that survived, like Amazon and Google, were the ones that had a path to actual revenue and profit. The rest, the ones built on pure hype, were wiped out. Today, AI is the real technology, just like the internet was. But the valuations are based on hype, not revenue. And the costs are out of control. So what will pop this bubble? It could be a number of things. A major AI startup could spectacularly fail after burning through billions of investor cash. Revenue growth could officially stall as services like ChatGPT and Copilot hit a wall. Or the big tech companies could simply look at their balance sheets and decide they can't keep throwing billions of dollars into a black hole with no return. That would create a doom loop, as their spending cuts would crater Nvidia's revenue, causing its stock to collapse and triggering a panic across the entire sector. Here is my prediction. Sometime in the next year, spending will slow down and the stocks will begin to falter. By 2026, major revenue misses will become undeniable, and Nvidia could see its stock fall by 50% or more. By 2027, the bubble will have well and truly popped, leading to mass failures among AI startups. From 2028 onwards, the market will stabilize. The survivors will be the companies that found a real, profitable use for the technology. When the dust settles, I believe that of the $10 trillion in market value created by this hype cycle, $8 trillion will have vanished. AI won't disappear. It will become like the internet or the cloud, essential, boring infrastructure. And its valuation will reflect its utility, not its hype. So why does this matter to you? This isn't financial advice, but it is pattern recognition. If you own Nvidia stock at these high prices, you are exposed to significant risk. Even the big tech giants are likely to see a 20 to 40% decline as they are forced to write off their failed AI investments. And if you've invested in AI startups, know that historically, 90% of them will fail. You may want to consider de-risking. Take some profits off the table, diversify your portfolio, and wait for the post-crash opportunities, because they will come. The technology works, but the expectations are impossible. And when expectations meet reality, reality always wins. Thanks for watching. Thanks for